Hello and welcome to the Cedar River Capital third quarter market update slideshow. Date today is September 15th, 2022, and we'll be discussing the main driving factors in the stock market today. My name is Paul Latta. I'll be doing the speaking for this slideshow, but my business partner Baj Kochar and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. Our slideshow today will have the same format as prior slideshows. We'll begin with a discussion about the recent market action, what's hot and what's cold. We'll then touch on top 5 points of discussion amongst investors today, and then we'll conclude with some historical context about long-term stock market performance. To provide market context, this is a chart of the S&P 500 over the last 5 years. Good news is that the S&P is up 57% in the last 5 years, but 2022 has been a challenging year so far, with the S&P down just a little over 17% year to date. This slide summarizes the main headwinds and tailwinds in the market today. On the right side, we can see the top headwind remains the hawkish Federal Reserve, which has been raising rates aggressively to fight off an elevated and stubborn inflation, mainly related to ongoing post-COVID supply chain constraints as the world emerges from the quarantines. Inflation remains over 8%, well above the Fed's target rate of 2%. The Fed has been raising interest rates at the fastest clip in over 25 years. Consensus for year-end is that Fed funds will reach 4.25%, a big change from near zero at the beginning of the year. This is a big headwind for the economy and for the stock market. The Russian invasion of Ukraine is aggravating inflationary pressures, especially related to energy and food costs. The risk of escalation of the conflict remains ever present, whether that escalation be in the form of expanding to other geographies or expanding the conflict beyond conventional warfare. Europe and China are both facing region-specific issues that are headwinds to the stock market. The European Union has arguably the highest inflationary threat in the developed world, partly by being close proximity to Ukraine. But the European Central Bank also has its hands tied on hawkish policy, which threatens to fragment the European bond market and possibly even the European Union itself. China continues to struggle economically, mainly due to its COVID-0 strategy and related lockdowns. Of course, it's important not to lose sight of the tailwinds, which are grouped on the left-hand side of this slide. Top of the list is improving prospects for COVID recovery worldwide. Most countries of size, excluding China, are experiencing a tangible return to normal. Good news especially for the hard-hit travel and destination entertainment sectors. Valuations have improved, of course, mainly on the market pullback and are nearing multi-year lows. Lastly, it should be mentioned that bonds generally remain unappealing, with more Fed rate increases likely in the near term, though it is fair to say that bonds are less unattractive compared to our slideshow 1 or 2 quarters ago. Sector performance in the last 3 months has been very different from the first 6 months of the year. We tend to regard inflation debates as a tug-of-war between Texas and Silicon Valley. That is, raw material businesses like oil, farming, and mining outperform amid inflation, whereas consumer technology businesses underperform amid inflation. So we can see in this slide that energy started with a bang at the beginning of the year and at the expense of technology. That's cookie-cutter behavior. But in the last 3 months, energy has taken a back seat and has done rather poorly. Tech, however, has not taken the leadership. We suspect the narrative around peak inflation has been the main driver here. That said, the first half performance of energy was so strong that energy remains the best year-to-date sector, even despite the poor performance in the last 3 months. The last 3 months have had a defensive bias in favor of non-cyclical sectors and have been led by the utility sector, arguably the most defensive sector in the S&P. Healthcare, which is also a non-cyclical sector, finished 3rd place in the last 3 months. Curiously, the consumer defensive names have not held up that well, mainly reflecting inflation-related cost squeezes. S&P does not have a breakdown for producer staples, lumping them into basic materials along with producer cyclicals. However, producer staples have performed admirably since they benefit from inflation, but are not economically sensitive. Here we can see market performance by style factor. In the far right columns, you can see performance for the first quarter, second quarter, and third quarter through mid-September. The style rankings mainly reflect a ranking by defensiveness in the bear market of the first and second quarter, and with the market rally in July and August, the third quarter column flips that ranking upside down with the more aggressive styles bubbling to the top. Income, value, and low volatility are inherently more defensive than growth, high beta, and story stocks. There are a few other factors at play when looking at subsectors and specific companies within each style factor, but the breakdown by offense versus defense seems to be the main factor in determining which style factor bubbles to the top or drops to the bottom in recent quarters. Stock market valuation is nearing 5-year lows. This chart shows the S&P 500 in blue, and then the forward price to earnings multiple in purple, going back 5 years. You can see that the market multiple peaked in 2020 a little over 23 times and has since pulled back to its present level of 16.8, which puts it near the low end of its range of 14 to 23 times over the last 5 years. Now, fundamental analysts may squirm a little bit on the PE ratio, knowing that with the Fed raising rates, the economy will slow and earnings will be revised downward. That said, most rate hiking cycles result in soft landings, not hard landings. Granted, this cycle has a more meaningful inflation threat than any cycle since the 1970s, but at this point, downward earnings revisions have been quite small. Purists may prefer a longer-term measure of stable earnings like that of the cyclically adjusted PE ratio or the CAPE ratio. However, one will arrive at a similar conclusion that stocks are simply more compelling today from a valuation perspective with a CAPE of 29 versus a 5-year range of 24 to 40. We'd now like to move to Chapter 2 of our slideshow, which is our top 5 list of the most discussed debates on Wall Street. Our top 5 list of the most pressing debates on Wall Street includes the European Central Bank dilemma, China's COVID lockdowns, peak inflation, earnings amid recession, and the upcoming midterm elections. We'll begin our top 5 list with the dilemma faced by the European Central Bank. While most central banks around the world have been fighting inflation with higher rates and selling bonds, the European Central Bank was one of the last banks to raise rates, and it has yet to sell any bonds from its sizable €9 trillion portfolio, most of which was accumulated during the COVID-related quantitative easing. The foot dragging at the European Central Bank mainly reflects political challenges of trying to implement an unpopular hawkish policy amid such a wide range of needs of the 27 member states. Push too hard, and the bank increases the risk of the European Union falling apart. But if the European Central Bank is not hawkish enough, they risk inflation getting out of control. Quite the dilemma. Eurozone inflation has leapt higher in the last year, not unlike the US and many regions of the world, as businesses wrestle with constrained supply chains amid improved demand related to COVID recovery. Eurozone CPI in the most recent report from August was up 9.1%, the fastest increase since the introduction of the euro currency in 1999. Inflation within Europe did run higher in the eastern periphery, which is closer to Ukraine, and a little lower in the western part of Europe. Inflation in Europe at 9.1% is a tad higher than the 8.3% in the US. And while the US and Europe headline inflation rates are comparable, the underlying constituents are not. Recent US inflation has been headlined by high costs for shelter and for medical care. However, most of the Europe inflation has been due to ripple effects related to natural gas constraints of Russian natural gas pipelines. Since natural gas demand peaks seasonally in the cold of winter, this suggests that inflation in Europe is likely to accelerate in the next few months, the opposite outlook for inflation in the US, which is facing a stiff resistance from aggressive policy action by the US Federal Reserve. Consequently, unlike the US, Europe is at risk of a cold, hungry winter on the Russian natural gas scarcity inflation threat. Is the European Union actually at risk of breaking apart? This slide shows the widening spread on Italian bonds versus German bonds over the last year. For long-term global investors, this chart really shows the increasing probability of a breakup of the European Union, especially if the European Central Bank policy leans too hawkish, in particular with regard to quantitative tightening. For long-term bond investors, the widening spread on Italian bonds is a familiar ring. Indeed, this is a revisitation of the PIGS problem of the past 15 years. PIGS, of course, is an acronym for Portugal, Italy, Ireland, Greece, and Spain, the most debt-laden countries of the European Union during the 2008 Great Recession. While there was much discussion about kicking Greece and other pigs out of the European Union, the pigs held on, partly due to shifting priorities amid Brexit. But what really helped the pigs and pigs bonds was COVID-era central bank policy, which emphasized buying bonds as part of a quantitative easing program. Of course, with the rather dramatic spike in inflation in the last year, that central bank policy has done a 180-degree turn. Most central banks around the world have flipped from buying bonds as part of quantitative easing to selling bonds as part of quantitative tightening. The European Central Bank is one of the last central banks in the world to not implement quantitative tightening. It seems the European Central Bank is sensing that no one wants to buy their junk-rated PIGS bonds. Indeed, if the European Central Bank pushes too hard, member governments may find it hard to finance operations, which will spill over into politics, which could again lead to separatist movements. The European Union has introduced a new transmission protection tool to address these fragmentation risks. The tool basically allows the European Central Bank to sell bonds, but restrict sales to healthy member states. In other words, sell German bonds but do not sell Italian bonds. This tool is likely to see a German court challenge. While a breakup of the European Union seems far-fetched, especially amid tensions with nearby Ukraine and NATO membership actually expanding, not contracting, bond market analysts have nevertheless been referring to the yield premium on Italian and Greek bonds as a risk premium for possible separation from the European Union. The European Central Bank is indeed moving slow on inflation. Rate increases are happening, but are months behind other central banks. Quantitative tightening has not started and is unlikely to happen this year. The new transmission protection tool will be controversial if it even happens. With the central bank in Europe not addressing inflation quickly and head on, but rather dawdling with slow rate increases and no bond sales, there are several global implications. First is that it increases the risk of European inflation spreading to the rest of the world via global supply chains. We're already seeing this in the global fertilizer markets, which is spreading to various grain and protein markets. Second, Russia is aware that the European Central Bank has its hands tied and is unable to fight inflation. And of course, Russia, being essentially the gas station of Europe, well, it really thrives on inflation. Moving on to number 4 on our top 5 countdown, China COVID lockdowns. Why is China the last country in the world still suffering from COVID? Well, the party line on the left of the slide has some merit. China is more vulnerable to COVID than the US. The vaccines are attenuated virus vaccines, which are less effective than the messenger RNA vaccines in the US. Also, the elderly are disproportionately unvaccinated in China. And China, of course, has a much higher urban density, which creates some vulnerability, and it's had a very bad experience with Hong Kong in the first quarter with the world's highest death rate. Still, China is dealing with Omicron, which is less threatening than prior strains. Is there something else going on? Well, yes, indeed. Xi Jinping is on the brink of being elected chairman of the Chinese Communist Party, a title not held since Mao Zedong in 1982. Elections are imminent, due in mid-October. There have been more than a handful of articles in the Wall Street Journal and Financial Times and other publications noting that the COVID lockdowns are being used as a means of pre-election social control and blame shifting. Quote, when introducing measures to address a crisis, the top leader can firewall himself from any political responsibility from the course of the correction, according to the Wall Street Journal. Of course, China will eventually lift the COVID lockdowns and growth will eventually resume. But in the meantime, the lockdowns are dropping Chinese GDP growth down to near recession level of 0.4%, well below the 6.4% average pre-COVID. The manufacturing shut-ins are aggravating global supply chains. That said, lower growth is reducing inflationary pressure on global commodity prices like oil and steel and copper and whatnot. When the lockdowns do lift, we should see a reversal of these lockdown effects, better Chinese GDP growth, improved supply chain throughput, but with higher commodity inflation from increased Chinese consumption. Moving on to number 3 on our top 5 list, the peak inflation narrative has been driving Wall Street for most of the third quarter as we saw headline CPI growth drop from 9.1% in June to 8.5% in July. But the peak inflation story took a bit of a beating with the August CPI report, which came out in early September, showed headline CPI actually still dropping down to 8.3%, but the underlying core inflation numbers actually worsening. The hard sell-off in the stock market likely reflected unrealistic expectations for core inflation, expectations that were likely influenced by lower prices at the pump. Alas, though, the inflation surprise did not arise from higher fuel prices, but rather from everything else. Top of the list was cost of food, cost of shelter, and then cost of medical care. With core inflation still a problem, the Fed is as hawkish as ever. This chart shows consensus probabilities for the Fed's policy rate over the next half dozen Fed meetings. Interest rates are headed higher. How high? Well, the Fed funds terminal rate is likely headed to about 450 to 475 basis points by about May of next year. That's quite a change from near zero at the start of this year. The higher rates are already impacting interest rate sensitive sectors like housing and autos, and just beginning to show in transportation services like FedEx. One asterisk here is the recently passed Inflation Reduction Act, new legislation that is really aimed more at climate change initiatives and has essentially no features that address inflation. Indeed, the CBO estimates the Inflation Reduction Act will have no statistical effect on inflation. So fighting inflation will remain the job of the Fed, not Congress. Can the Fed contain inflation? Well, we believe the answer is yes, the Fed will succeed, but the road will have some bumps along the way. To begin with, higher rates will eventually slow demand to match constrained supply chains. There is a lengthy history of success supporting the Fed going back to World War II and before. And of course, the Fed is not acting alone, as most central banks in the world are executing similar plans. That said, as we saw on slide 16, much of the core inflation is coming from food and medical care costs, areas that are not particularly sensitive to higher rates. Further, the second largest central bank in the world, the European Central Bank, is not really able to help with very limited ability to fight inflation at present. And then lastly, China lockdowns seem likely to end after the Xi Jinping October elections, and the post-COVID China recovery is likely to surge commodity demand and pricing. So the Fed seems likely to succeed, but the road ahead may not be super smooth. Moving on to number 2 on our top 5 countdown, there's clearly an elevated fear of recession, which begs the question of how corporate earnings have held up in prior recessions and how corporate earnings are comparing today. This chart shows that nearly half of the companies in the S&P 500 have cited recession in the second quarter conference calls. We suspect this number will increase in the third quarter calls that begin in about a month. The recession fears are coinciding with other indicators such as yield curve inversion, where a much watched spread between the 10-year Treasury and the 2-year Treasury is at about a 20-year record. We've also seen weak gross domestic product figures in the U.S. in the first 2 quarters of the year. And copper and lumber futures, which are leading economic indicators, have both softened meaningfully in recent months. This slide shows how much corporate earnings declined during recessions by looking at the last 4 recessions over the prior 35 years. On average, the earnings dropped 47.4% during these prior recessions, though not all recessions are equal. The Great Recession of 2008 hit corporate earnings the hardest, dropping earnings by a whopping 77.5%, whereas the 1991 Gulf War recession saw earnings drop a comparatively mild 27.4%. Of course, the economy is cyclical and recessions are followed by recoveries. The average earnings recovery over the 2 years following a recession was 152%. And generally, the bigger the recession, the bigger the recovery in earnings. Earnings estimates are headed lower, but revisions have been very modest so far. Third quarter reports will probably give more clarity and are likely headed lower, but downward revisions are small, mid-single digits so far, maybe low double digits within a few months, again, relatively small. Earnings in some sectors are hit harder than others, especially the cyclicals. Also, consumer staples earnings are not as safe as prior cycles, mainly due to the inability to push higher costs through to consumers. Producer staple earnings actually are holding up better than consumer staples, though there are very few producer staple stocks in the U.S. Healthcare and utility earnings are actually holding up comparatively well. So yes, earnings are likely headed lower with hawkish Fed policy, though again, we are seeing fairly modest declines at this point, not the 50% declines as we've seen in prior recessions. Coming in at number 1 on our top 5 list is the upcoming U.S. midterm elections. This chart shows that the president's party typically loses seats in Congress at the midterms. Specifically, over the last 22 midterm elections, the president's party lost an average of about 28 seats in the House and 4 seats in the Senate. Of course, there are factors that may swing results one way or another in this midterm. Biden's approval rating has lifted a bit in recent weeks, but remains low at present, which may shift seats in favor of Republicans. But the recent Roe versus Wade reversal in the Supreme Court may shift seats in favor of Democrats. How does the stock market do around midterm elections? Well, not so great. Usually still a positive year, but below average, and with returns all occurring after the elections are over. Evidently, markets do not like uncertainty. Market volatility is also higher in midterm elections. Importantly, an average market return in the year after the midterms is an impressive 15.1%. There are, of course, other factors besides the elections, as we know. Still, this is an encouraging factor for 2023. We now like to move on to the final chapter of our slideshow, where we give just a little bit more of a historical context for the stock market. This is a chart of the U.S. stock market over the last 150 years through May of this year. The chart shows $1 invested in the U.S. stock market in January of 1871 has grown to $24,872 as of May of this year. It also shows the 4 main market crash episodes in red, as well as several smaller episodes, which highlights the length of time for the market to reestablish new highs. While it can take a number of years to move to higher levels, the consistency of getting to higher levels is persistent. This means that buying during these dips tends to be a positive experience. Of course, it's tough to time the market and buy at the very bottom, but over the long run, there is merit to buying on pullbacks. When looking at long-term stock market history, it helps to bear in mind that the constituents of the Dow Jones, well, it evolves over time with changes in technology, changes in demographics, even changes in the number of states in the union. This chart looks at how U.S. stock market sector breakdown has evolved over the last 200 years. Railroads and other transportation stocks were a big deal in 1880, the early days of the Industrial Revolution. Communications and technology have grown in recent decades, as might be expected with the information revolution. Still, despite enormous changes over the last 150 years, the stock market remains as robust as ever as a font of new capital formation and as the primary retirement vehicle for generations past and present. We conclude today with a slide that we've used before. It's a simple reminder that bear markets frequently lead to bull markets. This table looks at the 14 largest drawdowns on the stock market since the Great Depression, and then shows the returns in the subsequent 1, 3, and 5-year periods. The returns are meaningful, with 1, 3, and 5-year returns of 53%, 88%, and 139%. The takeaway here is that you really need to be present when the market does turn. And while it's unlikely that our future post-trough return will precisely match historic returns, we can say that bear markets frequently do lead to bull markets. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.